the global markets are under quite a bit of pressure. So at this point, Hang Seng is down almost 350 points. The Japanese market is down about 220 points. So there's blood across the entire Asian market screen if you look at it right now. And I don't think we're going to be spared this morning. But Udin Mukherjee joins us to analyze the trends in the last couple of weeks. Udin, hi, good morning. There's been a slowdown in the markets globally in the last 1 week. Do you expect to see more, given that the news flow is only negative?
Hi Sonia, good morning. Well, I think there's a little bit more to go, particularly with how the markets closed on Friday in the US. We are trading at fairly important support levels right now, around that 8200 level on the Nifty, and it should have held out had it not been for the additional burst of global turbulence. But I think that comes under threat this morning. It's difficult to say where the Nifty stops falling, particularly because it's under strain from two heavyweight clusters, upstream oil and IT. And I think both those clusters might drag the index a bit more. So it's difficult to say. Maybe we get dragged down to that 8,000 psychological level if we break conclusively below 8,200 and close there. I think the serious medium-term support is still that cluster between 77 and 7,800, which we did not violate in the last correction. I think that has emerged as a fairly significant level. I know we are fairly far away from it, but having lost about 400 points on the Nifty already, that I think is the absolute solid support which the Nifty probably will not break unless there is mayhem in global markets throughout the rest of December. So maybe a little bit more to go, but it depends now on where global markets settle and whether we do go down all the way to sub 8,000.
Okay, morning Udayan, thanks for joining us. Well, one peculiar thing that happened last week was that amid the falling markets, the IT space also fell, despite the fall in the rupee. And now with TCS also, expressing some concerns about its business, do you think, we are going to start to see more falls in IT?
Well, actually, the underperformance of IT started right in October when the results were not spectacular. And ever since, IT has been a bit of a laggard. There have been days of pullback, but broadly, if you map it post-results, where some of the big boys like TCS and HCL Tech delivered subpar numbers in the previous quarter, we did not see the same kind of outperformance that we've got used to seeing from IT. Things have got compounded of late by insider selling in Infosys. The fact that they sold such a lot of stock, all the promoters put together, certainly has worried some of the investors. TCS's guidance and cautious outlook last week will not help matters any further. So I think in the near term, there is probably a little bit more underperformance that we might expect from IT. Things may be a little murky because of the global outlook as well. IT does tend to track global market performance, and the fact that US markets and European markets have come off such a lot, and there is a little bit of scare going on with global growth, I think that will also weigh on the sector. So contrary to what has happened in previous large corrections, where defensive sectors like IT and consumers tend to outperform, this time it might be a little different, with IT actually underperforming, and that also becoming a bit of a load on the Nifty's back with its fairly significant weightage.
Okay, that's a cautious view. Another thing that happened within last week was that these good quality consumer names have scaled down their guidance. Names like TTK Prestige, Havels, etc. Would you be concerned, or is that a buying opportunity?
Well, Havels has corrected quite a bit last week. It's a high quality company specifically, but so is TTK Prestige. So I would wait for a little bit more slip in some of these names, because do remember that the valuations that some of these companies trade at today are not exactly inexpensive. So they can lose 15-20% and still not look terribly cheap in terms of absolute P multiples. So I would give them a little bit more room to correct, given that the disaffection for some of these consumer names is fairly newfound. So my sense is that they might correct a bit more, but you're right in pointing out that some of these very high-class franchisees might actually turn out to be buying opportunities if they come off a little bit more. But my bigger problem, Sonia, is with what is going on with sector after sector in the index. Consumers is a large weightage, and for the last couple of quarters, even in the last quarter, some of the heavyweights did not turn in good numbers. And from the start of the year, we've all been looking at some of these upticks to become more pronounced. Consumer patterns, investment patterns, and they've still not uptick to the kind of levels that we would have liked to see by the end of the year. So this entire year has passed, and if you look at the industrial output numbers, the consumption numbers, they're still not picking up to the level that one would have wanted to exit 2014 with. That, I think, is a bigger cause of worry, that a new government has come in, the mood has changed, the stock market is trading just 300 points off all-time highs, the Nifty, and yet you're not seeing the kind of pickup that you would expect to see in the real numbers by now. I hope the real numbers will not make the market wait for more than one more quarter, because then I think some serious disappointment might start to creep in. So the problem is more macro rather than some of these individual stocks, which are still very high quality companies, and I think another 5, 7, 8% down in some of these names would present buying opportunities.
Yes, unfortunately, our growth hasn't picked up, but global growth has begun to let off, as it were. Anyway, Udayan, the story of 2014 has quite clearly been crude. A lot of these companies like GAIL, Cain are already under quite a bit of pressure, not to speak of even BPCL. How would you react to that sector?
Well, you know, the big boys are underperforming, and that's not good news for the index. ONGC and Reliance have both started underperforming in a serious way. GAIL's lost a lot of ground, and it stands to reason why some of these companies will actually underperform. So as I said at the start, upstream oil and gas and IT probably are the biggest weights on the Nifty's back, or the biggest drags on the Nifty's back right now. So I think, you know, when crude falls, all of us in India celebrate in the stock market. We think it's obviously a good thing which has happened. But when crude falls as much as it has, then some unsavory questions also pop up, like the recent Credit Suisse report, which points out legitimately that there could be some strain on sovereign wealth fund investment in terms of FII flows. Why is crude falling so much? Is it only to do with some dynamics of the crude market? Or is it signaling some kind of malaise in the global economy, which we need to be cognizant about? So till a certain level, you rejoice when crude falls, because our macro stability factors do improve quite considerably, as is well documented. But when crude falls as much as it has, then it does have some implications which are not great, particularly in some of the oil upstream companies. The kind of questions which have come up in the last few weeks in the global market scenario and the way they have corrected. So it's a bit of a mixed bag right now, and I think everybody's trying to wrap their head around whether this kind of an alarming fall in crude is actually such a good thing, though it must be said that India probably is the biggest beneficiary in a macro sense from the kind of fall that we've seen.
Okay, so let's brighten up the conversation a little bit, Udayan. You know, the CPI data that came in on Friday has improved. So will the market cheer that, or do you think today global cues will supersede all of this?
No, global cues will drag us down, but I think the case for a rate cut is getting stronger with every passing day. The growth numbers are still not picking up to the extent the government and even the Reserve Bank of India would like to see. What might happen is that the RBI governor might wait to see out the union budget before he moves ahead with the first rate cut. That is certainly a possibility for people who are waiting for a rate cut in January. Maybe the governor might choose to wait another 4 weeks or 5 weeks and then see it out, then proceed more confidently with a rate cut. But I think in 2015, interest rate cuts is certainly a tailwind that the stock market should expect. And I think it would be very disappointing for the stock market if we go through the first half of 2015 and don't see at least a couple of rate cuts. I think that's something which is batting for the Indian market. In fact, a lot of things are. I just hope the growth numbers pick up a little bit. Inflation has come down considerably. Rate cuts look like they might happen after the budget or around the budget. Crude's back is broken. If in January you do get reasonably good corporate results or good earnings numbers, and you see some kind of stability in global markets, you know, sometimes you do see volatility in December, particularly after very good years. So there is a bit of a scare going on. People are talking about China, about Europe slowing down, but it could all be an excuse for markets or for fund managers to take profit after what has been an exceptionally good year across global equity markets. Once December is done, and if the dust settles a little bit and you don't keep getting alarming economic numbers going into 2015, it's possible that global markets stabilize and start to inch up once again. So the first quarter of next year, we do have the ingredients out here for us to bounce back from whatever levels we settle down at. And I would still not rule out 9,000 by the union budget if global markets stabilize. The wild card is this, that whatever the global markets are fearing today actually comes through, and markets get really roiled and worried going into 2015. At that point, we'll have to reassess our predictions, because then things might change. But for now, I think this is a December profit-taking phenomenon, triggered off by some weak global economic numbers. But I'm hoping and keeping fingers crossed that by January, things may stabilize.
All right. Till we meet again, Udayan Mukherjee, thanks so much for joining us and giving us your view.